price action shows you where a stock is moving, but it cannot show you the level of conviction behind that move. A candlestick chart showing a sharp rally without volume data is like a sports car accelerating on fumes. There is no physical fuel to maintain that momentum. That fuel is measured by how many shares change hands. It is often assumed that a green volume bar represents buying and a red bar represents selling. But every transaction requires both sides. If one person buys a share, another person must sell it. That single exchange creates exactly 1 unit of volume. The color of the bar is simply a visual aid to match the price candle above it. To make this data useful, we have to determine what constitutes a normal level of activity. By applying a moving average to the volume indicator, we can separate everyday background noise from the specific moments where trading interest spikes above the baseline. When we combine the baseline with price, we can identify a healthy trend. If the price is climbing while the volume bars consistently push above that average line, the rising participation validates the rising price. Establishing this moving average allows you to see if a price move has the participation required to sustain itself, rather than just drifting on low interest. Once you can identify a healthy trend, you can spot the warning signs when one begins to fail. The most reliable indicator of this is volume divergence. This chart shows divergence in real time. Notice how the price continues to climb to new highs. However, if you look at the indicator below, the volume bars are progressively shrinking below our moving average. This contradiction indicates that fewer traders are participating in the rally. Buyer exhaustion is setting in, and the volume needed to drive the price higher is nearly depleted. Recognizing this drop-off in participation is what keeps you from entering a long trade at the peak right before the price reverses. We can also use the effort versus result principle to detect institutional activity at major support and resistance levels. Look at the setup at this resistance line. We see a massive volume spike representing high effort, but it produces a tiny price candle, which is a minimal result. This anomaly suggests that large institutions are quietly stepping in. They are acting as a wall, absorbing all the buy orders from retail traders and preventing the price from breaking higher. If you treat all high volume as a confirmation of strength, you will buy at the exact moment these large institutions are using that retail demand to exit their positions. Let's apply this to a downtrend. The price falls sharply to a support line. The final candle has a long bottom wick sitting on a massive volume spike. Look at the mismatch. Is this a signal to short or a reversal trap? This is a reversal trap. The high volume combined with the long bottom wick shows that institutional buyers absorbed the panic selling to stop the crash. Successfully navigating the market requires translating these visual anomalies into an understanding of institutional behavior. To trade breakouts safely and avoid absorption traps, you can use a 3-step checklist to filter your entries. First, check the overall trend. Second, verify effort. A genuine breakout requires a large candle breaking resistance matched by high volume confirming participation. Third is the no supply test. The price pulls back on extremely low volume, proving no selling pressure remains. To summarize these core rules, trust the move when high volume meets a big candle. Identify the trap when high volume meets a small candle. Avoid divergence when the price climbs on shrinking volume and look for an entry on the no supply test. When you stop reacting to price alone and start measuring the effort behind each move, you move from guessing the next trend to trading alongside institutional money.